many of you want to be a millionaire?
Me!
Okay, well, I'm going to teach you some ways. I learned from Dave Ramsey. Dave Ramsey is a personal money expert. He is now a millionaire, but it hasn't always been that way. He didn't know how to manage his money early in his adult life, and one day he lost it all. Many times I've heard people say that there is no difference in saving and investing. Well, I'm here to tell you that there is. Saving is a short-term investment, and investing is a long-term. What that means is saving is putting money into an account right then and nothing really happens. Investing is all about time. Typically, you should plan to leave money in a type of fund for 5 years or more. The object of investing is making money off of money. If you invest properly, you will get to where you want to be financially. There are several types of ways to invest. The first way is putting it in a mutual fund. Putting it in a mutual fund, you become a part owner of company stocks who hold the mutual funds. It's less risky than buying individual stocks or having any other type of investment. It's better to invest in mutual funds that are at least 5 years old. They have a solid track record of acceptable returns within their fund category. The 3 types of funds in the U.S. are open-end, which is the most common. You must be willing to buy back shares priced at the net asset value. It has a personal investment manager who oversees the buying and selling in the fund. There's a unit investment trust mutual fund, which has a limited lifespan. It can sell shares in the open market, and they don't have to have a personal investment manager. And then there's a closed-end mutual fund. It only issues shares to the public one time. You must sell shares to another investor in the market, and it has a professional investment manager as well. You can take your money out of that one without a penalty. And then another way to invest is in corporate stocks. In corporate stocks, you own part of a company, like say you own Apple and you buy a part of the stock in it, you own a percentage of that company. When the stock earns, the company distributes it to its stockholders. The dividends is the profit distributed. They don't have to, but if the company chooses to pay their stockholders if they are doing well. There's a risk in those companies. If the corporate has a loss, the stockholders share the loss. The stock value decreases, which creates a capital loss. A capital loss is when an investor sells their stock at a lower price than they actually paid for it in the beginning. Dave Ramsey's view on stocks is that he does not own them. He does not suggest them as part of an investment plan. But he says if you really want to own stock for some reason, limit them to no more than 10% of your investment portfolio. The trick to investing is to buy low and sell high. Sometimes companies' profits drop, and then that's when you want to buy their stocks, when they're at a lower price, and then later they'll shoot up, and then you sell them, and that's basically the point of it. And you can put them in a certificate of deposit, but they don't pay as much as all the other funds do. An individual deposit pays money into account for a specific period of time, 6 months, a year, 2 years, and so on. They have a fixed rate of interest, which is higher than passbook savings, which is a saving account in which deposits and withdrawals are recorded in a depositor's passbook. The percentages are fairly low in certificates of deposits. Some bank or credit unions are higher than others. If you want to withdraw from the account early, you have to pay a penalty fee. According to Dave Ramsey's CDs, you should only be used for savings, not long-term investing, because of their low rate of return, which is a percentage of gain or loss in investment over a period of time. When you earn profits from an investment, it's called a yield. You have to pay attention to what you're investing in order to make money off of money. Diversification reduces your investment risk by putting money in different types of funds, and that's the best thing for you to do. Invest correctly and be smart about it, and you will end up where you want to be financially.